All right, over the page now, and it looks like property buying is changing. Surprise, surprise. With interest rates increasing, people are looking at creative ways to buy their first homes. And I've got Joe Tucker, who is the head of research of Property Principles Buyers Agency, who helps property investors build sustainable property portfolios. He's in the studio to talk about the current trends we're seeing and what happens next for property. Mate, welcome to the studio. Thanks for joining me.
Yeah, thanks for having me, Mike. This is amazing.
Well,
Let's do it.
start off, we're here to talk about what you've been seeing in the property space at the moment. Take us through some of the trends that you've witnessed out there. What are people doing with their cash while things are a little bit tough?
Yeah, a little bit interesting. I mean, this is what we were chatting about in May about interest rates starting to just increase. It was at 0.1, it's now at 2.25. So the RBA has gotten pretty aggressive in the raising of those rates. But really, property has always been and will forever be the balance of supply and demand. The increasing of supply is going to make values go down. So if you increase more demand, if there's more demand for the properties that you're after, it is going to make prices rise. So what we're kind of seeing out there in the market is with interest rates, what that does is it brings the demand down for assets because there's not enough capital out there in the market. So if you have an interest rate at 0.1, you can borrow a lot more money.
Yeah.
But what we're seeing out there in the market is that it's not actually affecting every single market exactly the same. So where you used to be able to just throw a dart at a map and you get some capital growth.
That's generally my type.
That's your investing strategy. Just several darts, make it happen.
But
it doesn't work as well as it did, last year and the year before. So when interest rates rise, you can't borrow as much money, but we're starting to see the higher end of the market, the more expensive and the more how do you put it? More expensive, more emotional purchases.
Yeah, right.
Just aren't growing as much as they did. Those markets are starting to soften, and we are starting to see some of the regional markets softening as well.
Okay.
But there are markets within markets of those regions, so there is still a high demand for property. So if you have let's say you have $1 million borrowing capacity at a 3.5%, rate, and it increases, it goes to 4.5%, you can now no longer buy $1 million property. It has to be 900,000. So the million people are going to 900,000, the 900,000 are going lower, 700, 600, and so on.
Interesting. It's an interesting trend, especially when you break it down like that, nice and simple for me, because that's me. But we're seeing more people buy in different cities than they live in, I understand, and of course buying in rural areas, as you mentioned there, rather than the city. Why do you think that is?
Well, it's lifestyle, right? It's that work-life balance that we all want to do. And there was a study done by JLL. They had it called it the Future of Work study. It was called Future of Work 2022. It said before COVID, 45% of businesses didn't offer any lifestyle or work from home type of way. That has now reduced to 9% of businesses that don't offer. So there is a massive amount of demand for people to go out there and experience a bit of life. You don't want to go too far away from the city, but the regional locations that have good demand are still doing very, very well.
Okay, I understand we also see people buying homes in partnership with friends and families and colleagues. They're sort of, reeling in anyone they can to sort of come together and buy a property rather than perhaps their partners. Why do you think that is? That's an interesting one.
Maybe they don't like their partners.
Well, there we go. That's a different show altogether.
That's a completely different show. No, but it takes 10 years to, 10 plus years to save for a deposit on a property. And if you get a really good friend or a family member, you can half the costs, half the deposit, half the borrowing, half the debt, and then get some of the upside as well. But you do just have to be very careful because looking at the borrowing ability after that. So if you do get a partner and you do want to move out, your borrowing capacity, depending on the bank, will look at, say, a $500,000 mortgage as you owning the entire thing, not just both people. So you've got $500,000, the other person has $500,000, rather than it being the $250,000 each. So it just affects your borrowing ability a little bit more. So
certainly.
Just kind of think about that when you're doing it. But there are other things like a guarantor loan, for instance.
Okay.
That's where your parents put the security of the property. They don't put any of their own cash. They just put security down to say, hey, we can put down that 20% deposit as security, and that allows you to get into the market sooner. And you can get even more creative. Some of the more creative things that we're seeing, and people are doing that and saying, Mum and Dad, I'm going to get a renovator delight property, and I'm going to renovate this property to the value of your security security. So I will then release your guarantor loan and I will own this property, and you've got no risk at all. Now, obviously, don't just go out there and do that.
That was my, yeah.
There is a caveat. You need a team of professionals to kind of go through all of that, the borrowing, the security, making sure everyone's comfortable with the process and have all the agreements stacked up. But yeah, it's possible. But really, the biggest thing, where there's fear and uncertainty in the market like we have right now, inflation is growing really high, we've got interest rates starting to climb, there will be a bit of a break. We'll see December and January having a bit of, I don't see there being rate rises. We'll have rate rises for November and December, 0.25 or 0.5, but they will stop and re-look at where we're at with inflation in January and February and see where they take it. So I think they'll give us a bit of a Christmas break.
Fingers crossed. Joe Tucker, thank you so much for joining me in the program and bringing all these numbers and things. This is something we could be unpacking a little bit more, I think, so I might have to get you back down the track, but certainly good to break down the trends that we're seeing at the moment.
Thank you, Mike.